Welcome to Life Chapters Money Choices, the podcast where we explore the financial decisions that shape the chapters of our lives and the emotional stories sitting behind them. Today we're opening the doors of a very familiar institution, but it doesn't have a logo, it doesn't have a banking license or a branch network or a fancy app, yet it may be one of the most active lenders in South Africa. It is, of course, the Bank of Mom and Dad. And for many families, this bank never really closes. It may start just with a little help with university fees and then a deposit on a flat or a car repayment, rent for a few months, maybe a business idea that's just one more injection away from success, or help when life genuinely knocks an adult child sideways. The instinct is obviously to help. It's so very deeply human. And I think most parents would rather take strain themselves than watch their children struggle. I know I certainly would. But the uncomfortable question is, at what point does that support stop being support and start becoming dependency? And what happens when that generosity begins to erode the parent's own retirement security? Because it's not just a financial conversation. This is about all of those emotions: love, guilt, obligation, unspoken expectations, all of it, and the very difficult art of saying, I love you, but I cannot keep funding this. Well, to help us unpack that, I'm joined by Tom Brukman, who's a certified financial planner at Chartered Wealth Solutions, and of course, Kim Potgieter, as always. So Tom, Kim, welcome. Tom, let's just start with that big uncomfortable one. When you sit with families where parents are still financially supporting adult children, what is usually really going on beneath the numbers?
Yeah, Michael, thanks so much for having me. I'm a big fan of the podcast and I've obviously been listening to the series, so it's nice to come and be invited on. This question is becoming far more common in most of our client meetings, and we've got an age range of clients, so I'm not even talking about various generations or specific stages of people's lives. It's becoming very common. I think the instinct to help and the innate human nature we have, as you said, around I want maybe the best for my children. I also don't want them to suffer. And that's I think that's where you get to the space that you talk about, where it's kind of enabling. It's enabling these children, adult children, I must add. I think that's important to state. Yeah, that's really what we're talking about. We're not talking about children in their adolescence and growing up and teens and so on, where they need the support, and that's obvious. To what adult children and that enabling, which it brings the parents, I think, a lot of satisfaction that they valued, that they are making themselves useful and contributing to this adult child's life, but at the same time either putting their head in the sand or dismissing the reality of what it is doing to their own financial situation and financial future.
And I think it's, yes, absolutely important. We're talking adult children here. And I've heard one financial planner refer to minor children as expenses. I don't view my children as expenses. Oh my word. If that's your view of the world, I'm sorry, we're on a completely different page. But I mean, just Tom, to say on this for a moment, what do you see as the most common forms that this kind of support takes? I mean, obviously we get the groceries maybe, or rent for a month, or does it often hide in smaller recurring expenses that nobody properly adds up?
Yeah, so it's interesting because the kind of, when I thought about today's podcast and I looked at a lot of different client scenarios, there was a commonality. And I think one of the commonalities and it kind of just carries on, is around the expenses that we just get used to as adults that continue, and a lot of them take the form in debit orders. So what I mean by that is something like medical aid. So you have your children or dependents on your medical aid, and that continues, and then you just adjust your lifestyle to the medical aid increases. And things that our clients aren't aware of. When your child turns 21, that dependent rate on your medical aid shoots up. It becomes a lot higher than what it was when they were before 21. But you just adjust. You cut your cloth and then you carry on. And that child actually, and I'm not defending the adult children in the sense of, there's a naivety to it, sure, and the exposure. And I think Kim will probably get onto the conversations one can have as well with your children, or we should have. But your child isn't aware of that. And so they don't know how much you actually are are forking out, let's say, and helping them per month. So we see the medical aid, we see the insurance. Oh, my child's got a car, just put on my insurance because it'll be cheaper. Yeah. I've got, the house and the various contents and insurance bundles that. And so the short-term insurance side becomes an easy one in inverted commas, but that adds up. So you have these, the adulting expenses that we all know now. I'm sure the three of us on this call know. But we don't expose our children to it from when they should be exposed, I guess, and in my view and our company's view. And then it just continues. So I think the smaller expenses, Michael, are okay. I think being able to, spend, I've got clients who help with their grandchildren's ballet for, 6-year-olds ballet, which is R1,500 for a term. I don't think that's the major impact. Obviously, it depends on your situation. I think it's those ongoing, reoccurring that are actually quite big expenses that just form part of the parents' budget, and they just cut their cloth.
And Kim, from your financial coaching work, what are the emotions that tend to drive this? Because I also get a sense generationally that, we're kind of part of the boomer generation. I'm probably on the cusp of boomer X, but it feels like the younger generations look up and say, well, you guys had it so good. Our cost of living is so difficult. Getting on the property ladder is so difficult. And so I guess there could be a certain sense of guilt maybe driving this. Or is it mostly love, a cocktail of emotion? What tends to drive this?
So Michael, just watching from, the many years that I've been doing this, I can talk about my own personal experience, but let's do what I've seen from clients, because I'm way better when I'm working with clients than when I'm working with my own children. But when I watch with clients, a lot of the time what it is, and I don't think it's the children's fault so often, I see it as more something, and Tom hit it perfectly. We want to be of value. So because we want to be of value, we've been providing and we've been looking after these children. We also have this feeling, and I can talk personally having it, we don't want our kids to go through hardships. We don't want our kids to feel what it's like to go without or to feel like they don't belong somewhere. So we get into this habit of and it really is a habit. Exactly what Tom's saying. It's a habit. We get into the habit of paying for things. Now we're paying for them, but we're not thinking about ourselves. And I think this is what the important part of this discussion is. We are not today talking necessarily about people that have got more than enough money and can give with a gentle hand. What we're talking about is people who actually might not have enough money for their own retirements, but now they got so used to it, they don't want their kids to suffer anything. They feel guilty when they've got to stop it. They feel so bad that they've got to stop it. And then they're going through all this, their own emotional trauma, and children feel it and children watch it. And then you will get those children that take advantage of it. So much so that many adult children will be told by their family, no, Kim and Tom say, I can't carry on paying your insurance. Or Kim and Tom say, we're not going to do this. And so we've met many an adult child that's gone, are you Kim and Tom?
But Kim, I agree with you. If you don't have the financial means to be doing this, then you really have to think long and hard. But even if you do, you look at billionaires, you look at the likes of Warren Buffett and Bill Gates and what they've done as billionaires, wrapping up their fortunes in trusts, giving a large part to philanthropy, and also making sure that their kids understand the value of money. So they understand there's a difference here between enabling or compassionate giving. And that's always something I've grappled with as well is, where is that fine line in ensuring that you are at least teaching your children good financial habits so that they are well-rounded individuals and you're not enabling through this kind of compassionate giving mindset.
Michael, I couldn't agree with you more. So, from our previous series, I'm always talking about our relationship with money and how we're watching our parents, and as young as 7, we're forming our relationship with money.
Yeah.
And I have to agree with you because there are so many parents that have overindulged, and I can only call it overindulge their children. And then it becomes the expectation, and then it takes away their children's ambition. And that is the worst gift. We do it naively, pretend maybe in the beginning, but it's the worst gift that we're giving our children because they're not getting the same satisfaction from life that we maybe got earning it. And that is where we're seeing a lot of dysfunction happen in families. So I'm 100% on the same page as you.
Tom,
can I come in there?
Where is that line between support and enabling, Tom?
Yeah, so it's such a fascinating conversation. I've had it with my parents. I've had it with clients. So it's in the same breath as Kim. It's also a deeply personal one for me. A lot of this to me comes around your principles and values as a parent.
Yeah.
And how are you going to show your children over time? It's not one conversation when they're 18. You can't expect that to be the panacea, and they're going to suddenly have this ambition or drive, whatever principle values you want for them. So it starts when they're small, as Kim said, with these money memories and when they get exposed, and helping them understand the value of what you believe is correct with money. So Michael, you've got a different value to me, and Kim's got a different value to me around it. So you start showing them that, and you start showing them consequences to how that works. So already I've got a 6-year-old and a 4-year-old, and this is a very simple example. We'll go to the shops, and I can guarantee this happened to every parent I've ever met. And I'll hear, Dad, can I have that?
Yeah.
Now, how do you? And that's a simple question and a very common. But how do you say, no, actually, we can't have that today because we've got a certain amount that we can spend on our shop, and that falls out of that. And if we save and we're careful and we understand how much we have, then maybe we can buy that once, but we can't buy it every time. And so you start, and I've seen that with my wife as well. We have conversations. We start, and our kids start asking it less.
Yeah.
Or they start asking, my son started to phrase, do we have money to buy that today? Instead of, can I have that? And so you see it starting to shift. And I'm not saying I'm doing the most amazing job. I'm just in it right now and seeing it. And I think then your kids are going to have their own personalities. I've got very different kids. I'm sure we all, you can have the same kids, the same household, the same parenting style, different kids. So you're going to have that. And then you hopefully you're going to do everything you can to build them up and to keep honest with them around this, that when they do get to the stage where they're going to go off on their own, they're going to make decisions, they're going to become an adult, and have to make these decisions. You've built in the principles and values that they understand that enabling isn't going to benefit them long term. And they're going to have to go through hardships, as Kim said. It's not easy, but I think it's an ongoing conversation, and starting earlier is far more effective, like anything, I guess, in this space.
Yeah, but it's a great example that you use. I've also got very young children, but I'm in a kind of modern post-divorce family where my partner's got adult children. So I can almost look at it from both perspectives. And I try and do what you do, Tom. I try not to solve the immediate discomfort of, Daddy, I want something now, which is easy, reflexive. Okay, let's do it. And then you'll stop nagging me. But you create that much bigger long-term problem if you don't inculcate that behavior. We're not perfect. I don't get it right all the time. But it is something that has created a safe space for us to talk about budgets and money. And the moment they got their first little savings card was another one of those moments to have these conversations. When we dial it back, Tom, to those who really are maybe skating on fairly thin financial ice. Let's talk about the numbers here. What does ongoing support actually do to a retirement plan? Maybe just flesh that out a little bit, because it's amazing how quickly these little bits of help add up to a serious threat to retirement security.
Yeah, Michael, and it can get boiled down to a numbers game, mathematically. So if you're someone who looks at their budget and really, we don't want our clients to be paranoid about their budget, but what I've always said is we need you to be aware of what you are spending, because it gives our clients the confidence to make decisions and have the life they want to live within the bounds they have, without having these anxious nights, early mornings, all these things that people fret about. So if you look at your budget and you see, sure, 15%, I mean, I've seen up to 30% of someone's monthly spending is going towards their children, 30%. So you can do that, whatever number that is. The percentage obviously is important. 15% in the medium and long term, so 10, 15, 20 years, can really pull back that sort of lifetime financial security by 5, 8 years, 10 years. You can get that space. So the numbers, and again, that's where the facts and the real truth lies in the numbers, as they always say. So when you start showing clients this, and we do, we start showing them the impact, because short term we think it's okay, but to expand it into the longer term is really important. That's the real impact, and it really is a huge impact, and it's quite startling. And I think it's important to show clients that. Absolutely.
And Kim, this is where the phrase, I think, you can't pour from an empty cup becomes so very real. But why do so many parents understand that kind of, maybe you do intellectually, but you still struggle to act on it emotionally?
I think it's very much our role that we play with our children. I think, and it's that whole emotional pull where we want to look after our children, and we want to be those people that, care about their families. And it's a discussion we're having, what is really caring for your children? So again, when something like this happens, you normally are putting your head in the sand and you're not examining it. So once the clients come in and we can actually show them the impact, that's when we see the major behavior change. Because before, what we see is, you can substantiate anything in your brain. You can, every year you can have the same story. Next year I'm going to change, next year I'm going to change, next year I'm going to change. But when you see that graph and you see the impact that you might not be having enough, I mean, Tom can say it. It is the aha moment. That's when we see the most behavior change. We then will even take it one step further, and we might bring the adult children in as well, so that they can see the impact. Because I often think as parents, you don't tell your children in what place you are. Again, we keep that all to ourselves, not wanting to upset anybody else. But when the children come in and see what impact they're having on the plan, and that their parents aren't going to have enough, that's when discussions then come, well, then I'll look after you and all of that. But again, it's much better to make sure that you have enough to look after yourself, because your dignity changes. Once you've got to ask your children for money, it changes. So it's the same way for children when they're asking their parents for money. There's something that's changing in their confidence. So it's a win-win for both when they both feel empowered that they can look after their own finances both ways. So I always advocate both of you being involved in this so that you can take the actions, because you both need to take the actions. It can't be one-sided.
Yeah. And
Mark, just to add to that, I facilitated quite a few conversations in this space, and overwhelmingly the adult children, I think the fear from the parents is, how are my children going to view me, and the money and emotions. And so, but overwhelmingly the children going, I'm so glad I knew about this. I had no idea. I want to work with you to change this, and I can adjust my life accordingly. I can make the effort. And then it actually becomes this really powerful, and it brings people together, and they're sharing in this space, because the emotions that they're hiding behind maybe before having this conversation are quite overwhelming, quite powerful. So it really, the children are responding positive. That's the message I'm saying for parents that find themselves listening here, that having this conversation is a positive experience, overwhelmingly, without a doubt.
Why we just need to have these conversations, full stop, around money, isn't it, Kim? And what we've been trying to do with the whole podcast series. You actually went back and spoke to your kids, didn't you, to do a bit of research for the podcast about the influence that this has had on them and their relationship with money. What did they have to say to you?
So I would encourage everybody to do it. If you've got adult children, ask them what you taught them about money. I was a bit of an eye-opener for me. So I have Ryan, who's 33, Josh, who's 25, and Gabby, who's now 20. As Tom mentioned, all the children have completely different personality types, but they all came back with their different one. My initial response from my son, who's 33, was, Mom, you taught me how to spend it. So I got a bit of a shock when I got it. Then it was ha, 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 ha. I'll give you something a little bit more meaningful. And he came back with, because, at first you're going, oh my gosh, I'm teaching people how to do this, and this is my child's response. But anyway, then he came back and he said, no, and that I taught him that financial success is important, but actually enjoying it is more important.
Yeah.
And you'll see there's a common trend between all three of my children. So the next one, Josh, who's in London at the moment, moment earning pounds. So he's very excited to have all this extra money that he's never had before, because he's still converting it back to rands. But he just said that for him, it was all around this relationship with it. He says, like, seeing it now and having more of it and it actually being his, he thinks twice about spending it. So he said for him, it's really been around, you need to respect the money. And that's what I've taught him, that you respect it. And then Gabby's was lovely. I mean, she's 20. She's totally dependent on us, but we do give an allowance every month. And she actually saves out of her allowance. But she came back and just said that for her, money must be used not to control it, and actually use it rather to enjoy every aspect of your life. And basically for her, she says she puts away, but at the same time, she's made sure she can enjoy it. And I went, okay, so my return on life and return on investment, my children have heard it. Because the big thing I want to say is, our children are not doing what you're saying. They're watching you. Yeah. So you can tell a child what to do, save your money, but if you're not doing it, they're not going to do it. And my consistent message has been, you know what, we invest and we regularly invest, but at the same time, we make sure we're living our life today, because we don't know what's going to come tomorrow. So for me, there's always been that balance, and it was nice to see it come out with the children, and something for listeners to do. Actually ask their children, because sometimes we're not actually aware of our behavior and what our children are picking up from us.
Yeah, no, it's so good to, and I think affirming as well for you, Kim, to see that message has landed. But I think the important lesson for those listening is that children do model their financial archetype on your behavior as much as on what you say. And I think just in parenting in general, sometimes we kind of get that wrong, and we think they're not watching. We lose our temper in a road rage incident on the way to school or something, and your children are watching all the time. And so important to model those behaviors that you want your children to have as well. I want to come back though, Tom, to the fact that, you know, many people are now also supporting not just adult children, but their grandchildren, as you mentioned, piano lessons or whatever it is, elderly parents at the same time, bit of a sandwich generation thing going on. What does that do to a financial plan? And are retirees and maybe pre-retirees underestimating the pressure of being the kind of financial shock absorber for the entire family system?
Yeah, that's exactly what we're seeing as well, Michael, this sandwich generation, as you put it. And obviously it puts their finances under pressure. And I think it's important for us that we spend time with our clients and we unpack their entire family. So when we're planning, we're looking at who are dependent and who are potentially dependent, on you. And have you had as a client to us, have you had a conversation with your parents? So not only your children, with your parents as well. So it works both ways. And we unpack that all, and we make sure we bring that in, because if we're not planning for that, the shock to one's plan and their confidence and everything is huge when something happens. Generally seeing the medical space for our clients' parents, so they've got the adult children and their parents, the medical space is the biggest concern, of course, that stage of life and what's needed, and various ways to cater for that and plan for that. You're not going to get sort of great insurances. When I say insurances, medical aid, gap cover, as soon as you're over a certain age, those insurances are out of reach for a lot of people, or they're not available. They're just not. They're not willing to cover those ages. So to cater for that's really important, and to make sure it's all in their plans. And it can be a bit of a shock, but again, the awareness and the client's understanding what they could be in for helps them, tenfold in just how they're living and how they're approaching each day. So yeah, the planning side's really important.
And Kim, I mean, it's difficult. How do you actually sit down and prioritize when they're competing claims? So you've got an adult child maybe needing support. You've got aging parents needing care. In my life, I've got to support my mom a little bit more than my siblings are able to. And then you've got your own retirement needs. And you kind of feel guilty if you're putting your own needs first here. I mean, is there a hierarchy of financial oxygen masks here?
Again, the place to start is first to look after yourself, Michael, because if you're not managing to look after yourself, what happens is you will stop being able to look after all those people's. And I think, I mean, in our country with black tax, it's a massive one. When we sit with young couples and they know once they're getting their first jobs, the parents are going to come, the aunts are going to come, the uncles are going to come, and it's kind of an expectation. And I always say to them, but we need to look after you first. So I think it's starting with your own financial plan first, basically looking at that, and then going, how do we then split what's left out for everybody else? And it's the discussion should happen earlier. So I've seen many people who have to support their parents. The parents wait and they don't tell their children that they're running out of money. Then all of a sudden, when they do have to support their parents, it's the full amount every month because they've got nothing. What we've seen work much better is if you know 10 years in advance and you start helping them with their investments, plus you start giving a little bit of money, then it's not so much responsibility on you that when you've got to pay it all. So I try and prioritize it from that sense and saying to people, if you know, so a question I always ask everybody when they come into Chartered is, who are the people that are dependent on you? And I always say we need to bring them into the plan. We can't leave them out. So we first work out what the client's going to need for their lifetime and their retirements and everything. Then we start going down the line of dependence and working out how we can do structured payments in the sense of not waiting until those people have nothing, then contributing it. And you know, Michael, there's a lot of times it's a brother or it's a sister or it's somebody else in the family. So it's not even just parents and children. And that kind of responsibility comes from actually allocating it. But you need to start with yourself first, because if you aren't going to have any, you're not going to be able to give everybody, and this whole thing is going to collapse.
Yeah, it's the whole empty cup analogy that I mentioned earlier as well. And it's important also, we've spoken about estate planning in the past to understand that dependents versus beneficiaries will come into how you structure your estate plan as well. So again, when we talk finance and financial planning, it is so much more than just the numbers or the spreadsheet. It is so holistic. Tom, let's make it practical as we reach the end of our time. How does one begin having this conversation with adult children? Let's put it in that bucket first. What are some practical ways that parents can set limits without feeling like they're abruptly just abandoning their children? Would you suggest maybe a phased reduction? How do you tend to approach this?
Yeah, I think, Michael, the practical way is to first you yourself become aware of what is it that you are, so what is the amount and where are these amounts going to that you're supporting your children. Then it's a conversation. You sit down and you factual about it. You say, I want to let you know that I've been doing some work with my financial planner, if that's where you've been, or I've been looking at my budget. And a part of my budget goes towards some of your expenses, which I want to just make you aware of what they are, because I'm not sure you are aware of them. And you start being open and honest about it. And then you be vulnerable. I think with anything in life, you be vulnerable and say, I want to try and make sure that we are looked after, myself and my spouse, whoever it is, that we're going to be okay. And in that process, we need to discuss all these amounts that I'm supporting you with. When can we start to move them over to you, and which ones would be a priority to you, and how does that fit into your life? And so not to say it's you or nothing, I'm going to cut you off. It's I think to be gentle and say, I want to work with you here. I want to make sure that you are able to handle this and to understand it, because there's an effect on me and I have to look after myself first, because I don't want to be dependent on anyone else. I don't want to lose my dignity. I don't want to lose my independence. I want to keep that if that's what's a priority to you. Then you start there. And you'll be pleasantly surprised, as I said, the conversation I facilitate with children and their ability to say, well, I want the best for you too. It's not just you wants the best for me. I actually want the best for you as well. Yeah. In most cases.
And then say, we'll cover this maybe for 3 more months, then half for another 3 months, and then it's your responsibility. So we're not leaving you in the lurch. We're giving you time. You can start building up that income or thinking of maybe tailoring your lifestyle accordingly. And then, maybe think of having we have kind of a budget for annual expenses that we try and stick to and ring fence for that kind of thing. And that also helps incur some discipline in the process. It still feels like such a difficult conversation, Kim. Why do boundaries they feel unloving? They just do, when in fact they may be the most loving thing that a parent can do. So what kind of language can parents use when they want to be kind of firm but not cruel?
I think the language we should use is one more inclusive. So when we keep all of this to ourselves and think we're doing our children a favor and not teaching them the basic principles, and this is what we're talking about today, the basic principles of how money works. So if we can have these conversations early, and I always see when people are already in their 30s and 40s and their parents are supporting them, it was often conversations that weren't had when they were younger. So for me, the loving, caring way is to have it as earlier as you can. So that for me is my first place I would start. My next one that I just wanted to mention is also fairness, Michael. So many of this is around fairness to the family, because often parents will hide what they're paying for one child and think that the other children can't see that they're busy helping on the side, everything.
Yeah.
And what it does is, we've also seen is it then starts putting a whole lot of distrust between the siblings. And then what that's doing is it's causing dynamics in a family that wouldn't exist if, again, we keep saying the same thing. We sound like we stuck records. We were having the conversations. So it shouldn't be this hiding, the secretiveness, and starting it earlier. So again, it's what Tom's mentioned, you've mentioned, and I'm saying, just come together. And yes, I know you say it's hard, but you must practice it. So we can keep saying it's hard and then just dig ourselves deeper and deeper and deeper.
Yeah.
So again, just do it in stages. Start one conversation and see how it feels. Then start another one. But what we do is we go, it's going to be too hard, I'm not going to do it. And then we just make the situation worse and worse and worse.
Tom, would you say there's value in bringing the adult child into a financial planning conversation with the family's financial planner? Because that independent voice could help depersonalize the conversation, maybe make the numbers a little less emotional.
Absolutely. I mean, money is emotional, and then you throw in family, and it's next level emotional. So our roles, financial planners, have always been that when we say we are an independent sounding board, we're not emotionless. That's very key. But we can keep neutral, and we can keep the conversation on track and facilitate in a way, because we know what the client's trying to achieve with the outcome. They're trying to just achieve some sort of first step, as Kim mentioned, whatever the conversation is. And I think we've become very well versed, and with the amazing sort of like training we've done when it comes to coaching and these elements of communication, I think we're quite well placed. I mean, we sit in this privileged position. We know so much deep, insightful, personal sides to people that being able to facilitate this conversation it is something that we are, I think, well equipped to do.
Yeah.
And you're right, the numbers become less emotional. And if my dad is telling me, this is, I can't support you, this is the number, as opposed to someone I don't really know, it hits differently. So, I think it's a great place to open up if you are someone considering this. Speak to your financial planner and say, can you help me with this?
Yeah, I think it's a great way, to your point, to depersonalize what is a very emotional, often complicated conversation. But they can be even more complicated. And I think we'll touch on that in another episode, because we haven't even spoken about, sometimes there's illness or addiction. I've had friends where that's been hugely destructive to the family dynamic. There's divorce, there's a whole bunch of complexity that comes into this, and fairness between siblings and estate planning. So I think there's still lots more to unpack, but I think this was a great first foray into the bank of mom and dad. We've opened the doors. Tom, thanks so much, and Kim, as always, for shining a spotlight in the vault. It's usually built on love, but love without limits obviously can become financially dangerous for parents and for the children. And really, the parents' financial security isn't selfish, as you said. It's part of the family stability responsibility. And that's why sometimes the most loving sentence in the world is also the hardest one to say, that I believe in you, and that's why I need to start taking responsibility. So thanks so much to Tom Brukman and Kim Potgieter for this episode of The Bank of Mom and Dad. We'll be bringing you part 2 in the next few weeks. This has been Life Chapters, Money Choices. Be sure to like, subscribe and share amongst your network. Until next time, this is me, Michael Avery, signing off.